Markets in the green, sideways as it was, but Ajay Bagga joins us on the show to help us understand what really we should make of the market mood right now. Ajay, hi. It seems like the market is getting very, very stock specific. It's rewarding good Q3 updates and punishing the ones which have not delivered. Do you think that's going to be the case? Very stock specific and no longer a case of rising tide or basket buying sort of, which was working out over the last couple of years?
Yeah, definitely. Because there is a big difference between the earnings and the valuation. So we saw that in quarter two. So a lot of the downgrades have got worked into the stock prices, but that is also leaving very little room to stumble. So any company which is coming out with poor indicative operating results also, we are seeing the market is having a very fragile sentiment towards it. Yesterday's sell-off, if you analyze it, the headline was more on the new viral infection, but in a strong market, it wouldn't have made that big an impact as we saw. And finally, when the secondary market numbers came out, domestics were buying nearly 2x the selling by the FIs. So clearly, it was a question of domestic investors also selling out while institutions were buying. So that's showing the skittish nature of the market, very little room to stumble, and good performances will see inordinate amount of market success, as we saw in a major retailer when they gave their operating results as very strong same-store sales year on year. We saw a very big surge in that major retailer. And on the other side, on the private sector banks, as well as a few of the public sector banks, when muted operating results were released, we saw a brief bout of sell-off yesterday. So it will be a very stock-specific action, given that it's not anymore a top-down, very macro growth story, but it's a late-stage market that is looking at the stronger pockets to invest in. So it will become extremely stock-focused.
So Ajay, where is it that you feel that valuations are bloated and earnings could be a little challenging from these levels?
Aisha, a lot of it has got taken out. Things like defense stocks, the railway stocks, nearly for the last 6 months, the valuations had run very high, and we have seen the correction coming in. The PSU, macro PSU as such, which were getting very highly valued. So overall, it was not a cheap market, but now this quarter, where are the opportunities coming in? And where are the no-go sectors? I would say, for example, something like cement, we were expecting post-monsoon, and with the festive cheer, there would be some recovery, but we are expecting one more poor quarter on earnings in cement. So you would see some further downgrades happening. But in IT, I think, especially after the Accenture numbers, what we are seeing is that finally the cloud and the AI part of IT is starting to kick in. And there's a very strong correlation of IT with the US GDP growth as well as the S&P 500 performance. So last year we have seen IT outperforming the Nifty, and we are quite bullish that now the worst is behind IT, and probably we made the bottom in IT a couple of quarters back, and from here on, you should see a pickup. Earnings might not be that great. It will be a weak quarter, but the market commentary should be good, and the IT correlation to the deregulating financials in US, so BFSI in the US should work out quite well. And overall, with a strong US exceptional macro, IT should work out well. Pharma has done well, and we are expecting pretty good domestic pharma results. So very strong results from the domestic pharma formulations. Telecom should continue to do well. Agrochemicals is a turnaround story happening, and you're seeing the price action already in anticipation. You should see better results. It's more on a very low base and very corrected prices that we are seeing that happen. Uh, uh, Within metals, I think the non-ferrous will do better. Ferrous has its problems, and steel, especially HRC segment, has seen a very strong degrowth in the pricing. So steel could be disappointing, but non-ferrous could be better. Public sector banks will continue to do very well. Private sector, especially after the operating results indicated by the majors, is not looking that hot anymore. Public sector banks are looking good, continue to look good, especially on the top end side. I think these are a few of the names. FMCG, again, very poor sales growth. So another muted quarter. Auto is bivalent. I think auto, you will see passenger vehicles and tractors doing better. Two-wheelers, not so much. Recovery, again, medium and high level commercial vehicles not doing so well. So it will be a split auto segment that we'll see.
Interesting. So let's also hear it out. In fact, from Gautam Trivedi, we were just chatting with him earlier today on which are the sectors that he's anticipating, earnings revival, or even for that matter, a little bit of a challenge in the upcoming quarter. Here are his views on the IT sector.
IT, I think, is way too early. I would love to see IT return because, again, another sector for the last 2.5 to 3 years has been quiet. It's picked up in the past 6 months, but in the hope that business will resume. But I think the question is, how is AI going to impact Indian IT? And question is AI, has the AI hype run ahead of reality? So hopefully over the next 2 to 3 years, we will see what exactly is AI going to be able to deliver profitably, and how those applications are going to be useful to boost productivity. So it's very early, but I think valuation comfort is there for IT. So if somebody wants to take a call, I think now might be a good time. The other thing which Indian IT started doing, which has been very interesting, and they've been sort of quiet about it, is the fact that the whole GCC phenomenon in India, which the whole world is looking at, frankly, you've seen a lot of the major US and European companies set up GCCs in India, but the smaller and mid-sized GCCs are actually outsourcing their own GCCs in India to Indian IT companies who are well equipped to actually manage and staff those GCCs. So I think that could potentially become a very big opportunity. A lot of the companies we've spoken to don't share how big that is or how big that was 5 years ago and how big that is as a percentage of revenues today. But I think that is a clear opportunity for Indian IT.
Okay, fair opportunity for Indian IT. Yes, the opportunity is there, but are they able to capitalize on that or not is the big question. The stocks for now are all reeling under pressure. Naresh, would you be a buyer in any of the IT names just ahead of the earnings season? I mean, HCL, TCS, Techem, all down and out.
So, given the volatility we see on result date, it's tough to take a trade. And we see weird movements all across. So, one of the stock could be up 8-10%. So, I would wait for the numbers. If there is a big gap down, Infosys is a bet which would look interesting, or post numbers if it crosses 1980, 2000, that could be interesting because that is back to the 2021 highs. So, that could be the new leader in the large cap pack.
Okay, we'll watch out for that, whether that does manage to lead the large caps or not. But for now, what's under pressure is PVR, and even Naukri is coming under pressure. Do you look at either of these names, Ajay, closely, or what about the overall urban consumption as a basket? Because the top end was doing quite well. Now the expectations from the budget are that maybe there'll be something which is done to spur the mass level as well. How do you look at consumption with that lens?
Consumption is a problem. Urban consumption is up about 4.5% year on year. Rural at about 5%. So rural slightly better. But what we have seen is the rural money that has been injected into rural economy has gone more into building up savings or paying off loans. So you have cash with the population increasing. Cash at hand with Indians has increased, but you're not seeing that translate into consumption coming through. One big reason of that has been the food inflation. If you look at it, the food inflation year on year are still running quite high. We are having a seasonal impact on vegetables because of the cold season. Normally, you see the price going down, but overall, over a year and over 3 years, that food basket has gone up, and that is catching up as the COVID era savings are drying up. So consumption remains a question, and it's a very big pillar for the Indian economy. Nearly 57-58% of our GDP is accounted for by private household consumption expenditure, which has not been growing, and multiple reasons for that, from employment to wage growth not keeping up with inflation. So the owners of capital and owners of assets have done very well, but the owners of labor have not done that well. So it's a classic economic quandary. How you get out of it? Normally, you pump prime the economy, you do big public works, create a lot of public employment and put money in people's pockets, which government has been doing. It got constrained this year for 4 months because of the national elections, and now the catch up is happening. Today, Railways came out with a very good number that they've already spent about 75% of this year's capex. Why do we call it good? Because the rest of the capex has not got spent. So somebody who's on budget, in 9 months they've spent 75% needs to be applauded. But the big tenders have been really lacking this year, and that is showing on the industrial balance sheets. That is showing overall in the consumption. So as the government expenditure catches up, you will see that growth. The second part will be more PLIs, targeted PLIs for manufacturing, because that's where a lot of the job growth will come in. And third, what your segment you were showing on GCCs. GCCs are now, they've got 1.9 million Indians employed. 19 lakh Indians are working in GCCs, and that's going to double again in the next 5 years. So some policies on the services side, which have really not got anything, but today the service exports have overtaken the manufacturing good exports. So it's a huge opportunity for India to be the knowledge base of the world. And I think a lot of work is happening there. More than 1,700 GCCs now running in India, and big ones. Foreign banks where I used to work now have 27,000, 25,000 kind of people working in their GCCs. Nearly something like 8 to 20% of their global employee base is now sitting in India. Those are the kind of opportunities we should be doing for the entire Fortune 500, Fortune 1000 kind of companies. So consumption is a function of how much money you inject in the economy and how much people are able to earn from that. I think both have been lacking, but high hopes on government spending more, and hopefully the budget giving something to the mid-tier, mass affluent kind of class. We have done well for the safety nets, and the top end can take care of themselves, but that mass affluent segment has not got much, and they need some kind of money to be injected into the pockets. That will see consumption recovering.
In fact, in the meantime, since we did talk about consumption as well, we spoke with a slew of experts to try and analyze what is it that their reading is of consumption, the disconnect between premiumization as well as the rural consumption, and where is it that they actually see investment opportunity.
I think structurally still the lower end of the consumption trend is still quite soft. The more discretionary, higher ticket consumption will probably do better, because there the consumer's balance sheet has generally been very healthy. If you want to do lower end consumption, then I think you are better off buying the platforms, because they are aggregating demand across all segments and growing faster than, let's say, an individual FMCG company.
You can see where there are signs of revival. Building materials segment, which is dependent on this real estate cycle, will start seeing an upcycle as well. Consumption is in a phase of transition. I won't say we are on the verge of a revival, but I think further deterioration should stop.
Conventional alcoholic beverages products are growing at 5% maybe. the premium category is growing at 30-35%. And I think that's really where the opportunity is for investors to really, and again within that, I think you're better off betting on the challengers, because the challengers are more agile, they're more ambitious, they're more aspirational, they clearly have a game plan to take on the big boys. Premiumization, I believe, is going to essentially play out. And it's not just premiumization, it's also moved towards the luxury end. It's a bit of increasing competitive intensity. A lot of the private players, smaller players who are well funded are pretty much out there splurging in terms of their spending on advertising and customer acquisition, which is impacting margins, impacting growth. Probably think maybe 2 or 3 quarters from now, they should be back onto a strong wicket.
Okay, premiumization, and that trend is here to stay. Ajay, what's the best way to play the theme even now? Because, you know, across categories in the consumption basket, you have those plays with exposure to the premium consumption. But where is it that you still find value?
Value, no. Momentum, yes, Aisha. Because value, normally we have such high valuations on the Indian consumption basket. So I would say quick commerce on the momentum side. I think this is going to be very huge. So quick commerce companies, and then QSR. QSR is coming back. The initial operating results from one of the majors have been very good, and that's pointing to a revival coming in. And third would be the value fashion. The value fashion segment has done very well. It transformed a few of the retailers' balance sheets completely. I think value fashion will continue to do well. So the retailers who are in that value fashion segment should do well. So QSR, quick commerce, and value fashion. These three consumption baskets looking very good. None of them is cheap, but you are getting your money's worth by investing in them. So momentum is there, valuation is high, and it will get justified.
The other data point, Ajay, that we are waiting by for is at 4 p.m. the advanced GDP estimates will come by. You look at all of these macro points very closely. What's the importance of this just ahead of the budget?
It is important, and our own study is that numbers will be much lower than the RBI number. It won't be 5.4. It will probably be near to 6 to 6.1 is what we are expecting. The issue has been the government spending. Out of the 4 pillars of the economy, private consumption expenditure not doing well. Private capex, okay, not that huge. Government capex really stalled, and that we are still paying the price. And then fourth, exports, okay, not that hot, and service exports doing well. That has helped to do some heavy lifting. But overall, 6 to 6.1 is the expectation for this quarter. So better than last quarter's 5.4. We will have improved. Last quarter was more idiosyncratic because of the monsoon, because of the heat wave and the elections. But I think what the big message, I would say, before the budget and before the RBI policy, big message is you have been too tight on monetary policy for too long. Because even now, if they cut, it takes 9 to 12 months to transmit into the economy. That is the big trouble. So RBI being late to the party means that we could have 3 to 6 months of stalling momentum, and then the catch-up phase takes longer. So what you need is a double barrel where the budget brings in some fiscal impulses, and then the RBI comes in with a monetary impulse along with it. Within all that, there is Trump sitting on Jan 20th. So I think everyone will burn midnight oil before February 1st, and then the RBI MPC. That big global factor is very much going to impact everything else.
Okay, lots really line up in terms of trigger points and of course what could act as a catalyst for growth. But other than that, we're closing in definitely off from the lows of the day, but not like a meaningful move, and definitely not latching on to the high point today, 23,700 thereabouts on the Nifty. But Kunal, any BTST ideas that you may have identified?
So, there are 2 buy calls. The first one is around UPL. After quite some time, the stock was confirmed a swing breakout and especially after yesterday's downtick of a couple of percentage points, the stock has managed to surpass even yesterday's high. So that could be a strong sign of a breakout. Buy with a target of 580. Stop loss could be kept at 530. And from the insurance pack, it's SBI Life which has managed to make a very strong comeback. It's nearing the levels of 1475, 1480, which is also closer to its 50-day moving average. So would suggest a buy with 1550 as a target and stop us at 1450.
Yeah, a couple of these insurance companies are perking up. Naresh, what about your top BTSC trades right now?
So that would be a buy on JK Cements. The stock has crossed the recent swing high, very close to crossing into new all-time highs. Good momentum here. Stop loss at 4780. Target price of 4900. Second is a buy on Reliance Industries, bouncing back from that 1220 mark. Stop loss at 1225. Target price of 1270.
Okay, that's the take on some of the BTST ideas. Reliance, that's quite an interesting one. 1239 on Reliance, currently in trade, and it's sort of, seeing a bit of a recovery, about 2% higher over there as we speak right now. But what about the laggards today? There's been PVR, there's been Zomato, Kalyan Jewelers, Naukri, MGL. These have been your biggest laggards. And within the blue chips, of course, it's been largely a mix of autos as well as IT, which has been a pressure point today. So HCL Technologies, TCS, both those stocks are going home as losers, as is the case with Infosys as well as TechM. But that's also the case with iShares as well as Hero MotoCorp. Kunal, you were flagging off the charts of iShares after it reacted very, very strongly with the breakout to its monthly sales data. But what next? Because after that big move, it's kind of, sideways now.
Yeah, it's sideways, but I think that could be a very good buying opportunity, especially after that kind of a price volume breakout of almost 200 to 50 points for Eicher Motors, in the stock clearing a major zone of consolidation. So for the last 4-5 months, I think if I'm not wrong, from the month of June or July, second half, the stock was getting to this band of a very tight consolidation. It was neither breaking below the 4700 mark, 4750, and then on the upside, the stock took resistance around the 5000 levels for quite some time. So it was stuck into this 200 to 50 odd point band for the past many months, and finally we've seen the stock breaking out on the back of much higher volumes, and that's a classical sign of a breakout for a stock like Eicher Motors. Now that generally indicates that we are now looking at a potential change of trend for Eicher Motors, and I think the last 2-3 days of a mild dip correction into the stock from that 5300 levels towards sub 5200 mark, I think should be taken as a good buying opportunity.
Okay, point taken. Aegis Logistics now high by 17%. Kirloskar Brothers is doing quite well. Intellect Design, RCF, Biocon, these are the big movers right now. Even Z Entertainment has managed to perk up in the last few minutes. KC surprisingly is under pressure, so there's a cut of around 5%. Info Edge, Blue Star, as well as Zomato, these are some of the names that we need to watch out for right now. But what's the sense when it comes to the real estate pack? That's the question, Naresh. What are you suggesting to do with the real estate investments if somebody has that?
So there we are seeing more selective moves. If you were to look at it, say for example, Oberoi has continued to do well. DLF has been consolidating. Godrej Properties has been consolidating. So out here, Godrej Property looks interesting because it's seen a correction from 3400 to 2600 odd levels. The lows in May, June were around the price point. So at 2500 or 25600 levels, Godrej Property looks like a good entry point.
Okay, those are some interesting ideas then coming in right now. But closing in, like I said, a little bit tempered in trade, just marginally higher is how we're shutting shop. Biocon, of course, is your big mover today. And that can be said about a BSC, about India Mart, NCC, Cyan. Interesting list of movers out there. Naresh, just very quickly before we wind up, any particular charts other than Biocon within pharma? Does it look like this is going to be, again, one of those bout of safe haven trades when it comes to pharma sector?
So some of the smaller names have started coming on radar in terms of volumes, and Alembic Pharma saw some volume uptick yesterday. Ajanta Pharma saw an uptick or forming a base. So it could be the small cap pharma names which could start looking interesting. So the whole basket, say even a JB Chemicals or a which has been consolidating, Orchid Pharma, which has been trending. So small cap pharma could be interesting in the pharma pack.
Small cap pharma is something that looks interesting at this point of time. Overall, for the trading session, it's been a fairly quiet one has to say. And after the kind of turmoil that we saw yesterday, it's pretty much par for the course. 23,700 is where we have managed to, kind of settle around. For now, if you look at the key indices, it's Z Entertainment, which is up 6.25%. Nazara Tech is perking up as we speak. PVR Inox, however, is down about 3%. Aegis Logistics doing very well for itself. ONGC up. Suzlon, Oil India, these are some of the names which are in the green. Even from the metals pack, by the end of the day, the likes of Nalco, Hindalco, Adani Enterprises, they have managed to hold ground, but clearly IT was the sole loser in the trading session. So TCS, HCL Tech, Tech Mahindra, Infosys, all the big 4-5 companies are under pressure right now.